Hi friends, Simit here from informedtrades.com. In this video, I want to review a strategy shared by Boris Schlossberg and Kathleen in their book, High Probability Trading Setups for the Currency Market. You can visit Boris and Kathy over at bkforex.com. This strategy is centered around using moving averages and the MACD indicator in conjunction. If you're unfamiliar with those tools, we have a bunch of videos about them on Informed Trades that you'd want to check out. Okay, the key points or the basic rules of this strategy: you want to wait for price to be above the 50 simple moving average and the 100 simple moving average. The price has to be above both of them. Not only that, but price must be at least 10 pips above both of them. So whichever one's higher, 50 or the 100, 10 pips above that one. MACD must have gone positive within the last 5 candles. If it hasn't, you simply want to wait for the next MACD signal. And when the next MACD signal comes, evaluate, are we still above the 500 and 100 simple moving averages by 10 pips. The initial stop that you place on your trade when you enter is the 5-bar low from the entry. So basically, look at the candle that gives you the entry signal, meaning the MACD has gone positive and the price is above the 10 pips above the moving averages, and then look 5 bars back and what's the lowest point there out of the past 5 bars. Place your stop below there. Then calculate how much you've risked, so that might be 30 pips or 50 pips or 100 or whatever. Multiply that by 2, and that is your first profit target. So when price goes twice the distance from where you enter in your stop loss, you take off half, and then you exit the remainder when price breaks below the 50 simple moving average by 10 pips. Okay, all of this is obviously easier to understand or clearer to see with an example. Okay, so we're looking at this is a Euro US dollar hourly chart. And this actually goes back to, this is a chart from 2004, 2005, but the same concepts still apply. So here we see price is above the 50 and 100 simple moving averages right here, but the MACD is already positive, and it's been more than 5 candles since it went positive. So here, 2 of the criteria are met. We are more than 10 pips above the 50 and 100 simple moving averages, but the MACD has been positive for too long. So now we simply have to wait. Here, the MACD goes positive again, and we end up being 10 pips above the simple moving averages, the 50 and 100 moving averages, within 5 candles after the MACD goes positive. So here we get our entry signal right around here. Okay. Then we calculate where's our low. If we enter here, 1, 2, 3, 4, 5, our stop's going to be right around here, right below this candle. Okay, so we enter here, stops below here. Then we exit half when the distance between these 2 points, where we enter and the 5-bar low, multiply that by 2, and then that's our exit point for where we take off half. And that comes up around here. So enter here, 5-bar low, put our stop below that puts us right around here. Multiply this distance by 2, and that gives us our initial profit target, which ends up being right around here. Once the price gets here, we take off half the position, and we move our stop to break even. So now we've got half profit, and there's no risk, or if the price falls all the way back down, we'll at least be out break even. And now we simply wait. Okay, so this is the 50 simple moving average, the black line is the 100. We wait until price goes 10 pips below the 50 simple moving average. So we go up, up, and that doesn't happen until all around here. So, basically we entered at 1945, we exit at 21.65, so it's 220 pips. And it's an example of, we got our initial profit, we were able to take half off, and then we were able to ride the trend. Another one of the rules that Boris and Kathy talk about in their book is, your risk should be predetermined and fixed, and your reward is somewhat variable dependent upon how price is behaving. This trade illustrates that. So our first reward was a little predetermined in that we knew how much we were initially risking based on the 5-bar low of where our stop was placed, and we could sort of multiply that by 2 to get our initial profit target. But ultimately, we do want to see if there's a longer trend we can hold on to, and that's dependent upon price action. So in this case, where this 50 simple moving average is depends on how price is moving during this period, during this time frame. It turns out, so we do have to watch the market a little bit or program it through an EA. And once price falls about 10 pips below, that's our exit cue. There is a short in their book, High Probability Trading Setups for the Currency Market. They offer a way to short this strategy, shorting based on moving averages and MACD. In this video, obviously, we just covered the long side. We'll have more videos covering trading strategies from them. You can visit their website, bkforex.com. If you have any questions, anything you want to add, you can join us at informedtrades.com. Thanks and best of luck in your trading.